This is about the best foreign investor voice that we can get at a time when the market is worrying why this FII money is almost, plateauing or getting into peanuts day after day as we linger between that 7,000 and 7,500 mark. The best possible voice to answer that, Jonathan Garner, as you said, Chief Asia and EM Equity Strategist with Morgan Stanley. Jonathan, thank you very much for joining us ahead of what should be a very busy day for you. I believe you'll have some 70 investors and 300 companies talking to you.
Yes,
okay, well, first of all, my question before I ask you what you're expecting from the corporates, why is the market dithering for so long? From the counting day, May 16th, when the Nifty got to 7,500, it has not been able to cross that level, and we often see even FII selling, albeit paltry amounts. Would you say the market is looking fully valued to you?
We did a study last October about emerging markets that have elections. We looked at over 40 elections over the last 25 years, and what we found was very pronounced. The outperformance tends to happen prior to the election date itself, and the strongest outperformance happens just as we saw in India, where we have what we called a popular opposition win. And this was a resounding win, clearly, and a mandate for change. And when we've seen that in other countries, we get very strong performance up until the election result itself happens, and then a peak around that. Doesn't mean the market necessarily falls, but certainly India's behavior since the election is very typical in terms of becoming range trading. The other thing I'd mention is, in relation to your question about foreign institutional investors, there was enormous foreign buying and interest in India up to the election results. So when we look at fund manager weightings, they're at all-time highs for India in global emerging market funds right now, more than double weighted. So the typical global emerging market fund has more than 12% in India now. That's double the 6% weighting.
Okay. But in India, we are led to believe that this is a qualitative change. For the first time, there is an absolute majority for what is perceived as a right-of-center government. Therefore, there is a lot of fundamental changes expected in the economy. Your own economist, Chetana here, believes that we are going to enter a kind of a 7% average rate of growth over the next 5 years. You don't therefore think that foreign investors will pass the situation for a bit and then a big buying is coming? You're not expecting, say, 8,000 around the corner?
We've looked again at other countries that have gone through this dramatic change. A notable example was Japan last year, where, again, we were very bullish around Abe-san's election victory. You had a very strong performance of that equity market, and then you've entered a more range-bound phase as we enter what we call the delivery.
The delivery
phase. Yeah, the delivery phase is crucial, and in his case, obviously, questions are raised about the delivery in relation to the third arrow reforms. We've obviously got the budget coming up here in India. I've been looking at the newspapers since I arrived. There's some very exciting changes that we're seeing about the basic administration of government in India, and it's all about delivery and good governance. That's what we want to see, and that's what the foreign institutional investors want to see. And if we do go through that process in a good manner, then there's every reason that foreign money should stay here, and maybe even more can arrive.
So your thesis is that at the moment the markets have drunk in, or investors have discounted the good news of a new government, but for further rallies they want action.
The delivery phase. And of course we haven't talked about valuations thus far. I mean, India is now back trading at more than 50% forward PE premium to the rest of emerging markets. As you mentioned, we're optimistic about growth picking up from here, but corporate ROE is very depressed. With that growth pickup, it should improve. But again, this is around a delivery phase on the ground in relation to corporate performance. That will take 1 or 2 years. But going back to our original study on elections, the real fireworks and excitement happens up until the polling day.
Okay. Well, how are you looking at the earnings trajectory in that case? Are you expecting earnings upgrades in 6 months? And are you expecting upgrades for FY15 itself or only for FY16?
Yeah, we're getting more optimistic on that, and what we've done on my side in our Asia ex-Japan focus list is we've added some old economy cyclicals to our exposure. So we've added a name like Tata Steel, for example, and we've also added Maruti Suzuki in the autos area. These are areas which have been relatively depressed and where we can actually expect a pickup. That sort of old economy consumer discretionary cyclicality is not actually what we're recommending elsewhere in Asia, where we're looking more at exposure to developed market growth. So in terms of domestic growth pickup, I think India is the most exciting prospective story that we have out here in Asia.
So what are your sector preferences now? Are you making no incremental additions to your kitty because the entire market is overvalued? Or are there pockets of valuation gaps, and you are still a buyer?
Well, if you go back to this time a year ago, when we were very worried about the twin deficits, when India's currency was at one point in free fall, and that was obviously arrested by the incoming central bank governor and a big external adjustment, at that point we were recommending pharmaceutical stocks and software stocks, so the classic unlevered dollar earners, and that's where most of our clients were. But as I just mentioned to you, we've lightened up, particularly on the software names. We've retained a core exposure in the pharma area, but we've added this cyclicality in the consumer and the industrial space, which speaks to our confidence that we are at some kind of a turning point here in terms of domestic growth.
Okay, so you see yourself changing the stance. Would you once again begin to lighten on pharma? At the moment you're saying that you are staying with IT and pharma, but also adding cyclicals, is it?
Yes, that's what we're doing now. We can never say what we're going to do in the future because we don't know what we're going to do in the future. It depends on the delivery phase.
Okay, let me just pull back and look at the entire emerging market scenario. How do you see smart funds behaving in 2014? 2013, they practically deserted emerging markets. Huge outflows practically from May 22nd, from tapering day up until almost, say, September, October, even November. How might the behavior change? We have seen some flow back, but it's not been a flood. Will emerging markets, are they likely to receive more funds in 2014?
And the overall situation is still quite challenged in the emerging world. I mean, unlike India, in most countries, we don't have a very strong vote for reform, though there are other elections ongoing. Growth is cyclically depressed in much of the emerging world. In some cases, there are very big structural challenges, in fact, even bigger than India faces, for example, in Brazil or South Africa or in Russia. And so in terms of earnings growth, as far as out as we can see, with the exception possibly of India, there's not an imminent pickup. Valuations are close to long-run average levels, and the fund flow situation, it partially reversed, but nothing like the degree of money coming back in as went out really from May, as you say, in fact, all the way to the end of January.
Okay, so I noticed you said that you're not terribly excited by Brazil, by South Africa and Russia. You didn't say China. So what are your favored emerging markets other than India?
Well, in China we have a completely different theme. We're overweight the new economy theme in China, which is what's now driving growth, consumer and services growth. So China's gone through the industrialization phase as we see it. So one shouldn't be expecting great things going forward from areas like steel, mining, capital goods. The debate about China is how quickly is it transitioning to advanced consumer and services driven growth, and we think it's actually transitioning faster than the consensus does, and there's some names that we like in those sectors.
Okay, so in your pecking order of emerging markets, what would be, say, the top three markets?
At the moment, our core overweights are China, Taiwan and Singapore on the countryside. Core underweights are Brazil, South Africa, and in this region, actually Thailand. And India's in the equal weight group at the moment. We were much more worried about India a year ago when it was very much in the firing line in relation to twin deficits. But we're happy to recommend a holding here in India, and particularly emphasizing this cyclicality in terms of the industrials that I mentioned earlier and some of the consumer names.
What would you watch out for getting into an overweight stance in India? Would you watch out for the fiscal deficit to fall? I mean, would the budget be and its expenditure and deficit number be important? Would it be the inflation number? Or would it not be any of this, but simply a pickup in consumption and capex?
Well, we've already traveled a long way, as I mentioned, on valuations. I mean, for example, versus some of the markets that were overweight, we're at near record valuations for India versus, for example, China. If you look at, say, Taiwan, we already have a strong pickup in corporate earnings growth and ROE. That may now happen in India, but we're entering that delivery phase. So we've gone through the expectations phase. It's been a fabulous election outcome for the Indian people in terms of a vote for change, but that delivery, transitioning from expectations to delivery, is really crucial over the next 3 to 6 months.
Oh, absolutely. I mean, I guess Indians are waiting for it much more than people abroad. One final question to you, which we have tended to forget because of the domestic euphoria or the local news. The rise in U.S. yields. That story has turned topsy-turvy. We've seen yields crashing towards 2.4%. How do you see the trajectory of yields as, you start seeing 10 billion shaved off by the Fed with every subsequent Fed policy? And is there something to worry about flows into emerging markets in the distant future, now that looks like a fear we have forgotten?
Yeah, one of the reasons the fund outflow stopped was that, as you rightly mentioned, bond yields went back down in the core markets. Some of that's weather-related in Q1. Some of it may be geopolitical factors. We've obviously been in a very volatile environment vis-a-vis, say, Russia and Ukraine. But as we go forward, we expect the US economy's recovery to strengthen further. There is actually a pickup we see ongoing in wage inflation in the United States, and we would suspect by the end of the year we're moving back towards a 3 handle on the US 10-year. That's not such a problem for India as it was this time a year ago, because it's one of the 2 countries that we were most worried about, the other being Indonesia, where those external imbalances have narrowed. Much more in the firing line are Brazil and South Africa going forward.
Okay. On that positive note, Jonathan Garner, thank you very much for joining us, sir.